Jerissa, thank you so very much for coming out and talking about the volunteer opportunities. And again, these programs cannot operate without this room here. As much as we'd love to run programs, we can't do it without the trained volunteers and people dedicated to the community. So thank you very much again for all your volunteer efforts. So we are transitioning over here and we'll be ready to begin our discussion today, dealing predominantly on taxable income items. So we're going to go through a couple different areas today, just talk about items of a little bit more certainty than what we had last week. I promise it's not going to be as confusing as determine how to define a child today. We'll worry about that next time when we talk about child tax credits and child independent care credits. Today's going to be a little bit more straightforward as we talk about more income items, how we're going to be reporting those on the actual tax layer program. So partial good news, we can get into the practice lab. It's not entirely correct, but at least you can play around in there a little bit. There are a couple new changes to the Form 1040 for the 2025 year. A lot of it is just more visual, but I have updated line numbers in here so you can basically find out where your favorite items of income should end up on the 1040. So we'll go ahead and go through a couple different items here today. One of the first questions we typically get here with volunteers is what type of income should be taxable? And we have just a brief list for you up here. This is not all the items of income, but the more common ones we'll find here within VITA. Again, once the 4012 should be updated, hopefully the page numbers haven't changed. Otherwise, my slides are completely out of date. But hopefully we'll be somewhere around the D3 area for all the items of taxable income. Predominant ones, wage, compensation, bonuses, alimony can be taxable. I'll talk about that in a little bit. Annuities, business income, debts forgiven, dividends, employer-funded disability benefits, gains from the sale of property, gambling winnings, interest, IRA distributions, jury duty fees, military pay, non-employee compensation, pensions, punitive damages, potentially refunds of prior year state or local taxes, rents, Social Security benefits, despite people thinking that they get to a certain age and they don't have to pay tax anymore. That is not true, but we'll talk about the taxability of Social Security. Potentially scholarships and grants, although we typically don't see that within the VITA program. Tips and gratuities, and I just want to highlight unemployment compensation. So those are the areas that we typically see for taxable income within VITA. But there is some good news. People may ask a couple other questions about other items. Good news is not all income is taxable. So sometimes we have people coming in and they ask about how do I report things like child support? Good news, child support is not taxable income. It never has been and is not taxable this year, despite any changes we've heard about in the tax code. Always good that we have these discussions. I don't want anyone to get their advice from the internet about what has changed in the tax code. Let's make sure you get the right information here. Damages for physical injury. If you're hurt and you're being compensated for a physical injury, that's not taxable compensation. Same thing, federal tax refunds will never be taxed. State and local may be. Generally, we probably won't see that here in VITA. But the big ones are gifts and inheritance. We typically get the question where someone's going to come in and ask, how much do I need to pay because I just inherited some money or I received a gift? Great news, not taxable. The person who receives a gift or inheritance will not pay tax on those monies. There's potentially a tax at the estate level, or the donor may pay a tax, but that's not for the recipient. There's no federal, state, or local income tax on gift or inheritance. Now, if they inherit something like a retirement plan, that's a whole different situation. We'll talk about that with the Form 1099-R. But insurance proceeds, if you're getting compensated for losses, again, that is non-taxable income. If you have tax-free securities like municipal bonds or something along those lines, typically tax-free. Going back to the sickness and injury, if you're hurt, if you're being compensated for a health issue, those are generally tax-free as well. Student loan forgiveness, right now through the end of 2025, that is considered tax-free income for student loan forgiveness if they meet the qualifications. As well SSI, veterans benefits, welfare payments, food stamps, and workers' compensation. So in the prior slide, I mentioned unemployment compensation. You're typically going to have to pay tax if you're getting paid not to work, if you're able to work. So unemployment compensation is you're no longer employed, but you're getting compensation due to the unemployment. If you're not able to work due to illness, injury, that's workers' compensation, that's not taxable. So there's a difference in the tax code, really trying to ensure that people who have a medical need are not being taxed on those payments. Now, we are going to go through a couple common forms of income. The 1040, as much as they wanted to simplify things, and I see a couple volunteers that have been around as long as I have, in fact, some even longer. And remember the years we tried to do a postcard, which was effectively just cutting the page in half, and we had multiple pages of the postcard. We're back to the normal couple pages of the 1040, just 2 pages, and a whole lot of supplemental schedules that'll go with the return. Good news is that for VITA, we're going to teach you how to work on the input. Where do these pieces of information go? The tax return program will put those in the appropriate categories. So the majority of income is all going to come to the front of what we call the Form 1040, the individual income tax return. So we'll see the most common forms depending on the site that you work at. If you have a lot of people who are employed, they'll have wage income. That'll still be on line 1A. Interest income on 2A, dividend income on 3B. I'm sorry, interest income on 2B. IRA distributions is going to be on line 4B. Pension and annuity still on line 5B. I do have the form numbers down next to these just to give you a reference. We're going to take a little bit of a look here at some of the forms themselves just to give you an overall idea. These are all government issued or government supported forms. So the W-2 series is going to demonstrate where wage income is going to come from. We're going to see a couple of forms that have a 10, a 0, and a 9 in it. They are very important to get into the return. The forms may look a little bit different based on who's issuing the forms, but all the information is going to be exactly the same. TaxSlayer does a very good job of setting up their input so that you can actually duplicate the information you see on these forms. So one of the other ones we'll talk about is Social Security benefits. Again, we'll enter the Social Security information exactly as it's shown on the 1099 SSA, and the TaxSlayer program will go through the computation to determine how much, if any, of that Social Security will be taxable. Now, the next session we run, I'll talk about deductions. So if you may have heard about no tax on Social Security, well, not exactly. Also, the no tax on tips and no tax on overtime is not really an exclusion from tax. They're going to be brand new deductions that we're going to talk about at our next section, which means we're going to have a brand new form this year with a whole list of brand new deductions. So all the ones that we talked about at the beginning of last session, I'll review those at our next one here. But Schedule 1 is going to be for those other items of income that can be taxable. As we mentioned, alimony can be taxable. However, it is only under certain conditions. So basically, any divorces that occurred after 2018, alimony is not taxable to the recipient, not deductible by the payor. So generally, these would have been alimony payments that have started many years ago. We're looking at 7 years ago at this point that the divorce has been finalized. So if someone has a alimony that they have on a prior year return, it's probably worth a discussion to make sure if they have any for the current year. There is no prescribed government form to say how much alimony is being received. It's something we need to make sure we get matched up between the payor and the recipient. Again, anything before 2018 was effectively going to be deductible by the person making the payments, taxable by the person receiving it, and so there's just a little bit of information. Again, we'll probably not see many people for the first time coming in with this issue. It's probably going to be on a prior year return. Unemployment compensation is also going to be on that Schedule 1, in addition to some other items of income like jury duty fee, trying to think of any other ones that we might see, potentially some miscellaneous income, but we'll talk about a couple of those items a little bit later on today. Okay, so apologize for the age of these things. We are going to take a look at a couple different features here of the W-2. This is our form that we'll be getting in terms of employment-based compensation. So if an individual is employed and receiving compensation, they'll be getting a W-2 at the end of the year. The W-2 may not look exactly like this. They gave the designers many different options as if there is a great benefit for one over the other. So we do want to just let you know there's some important information to find here, but you're going to find the forms in many different styles and designs. Not entirely sure why that is, if someone likes the look of their W-2 better than others, but all the information will be exactly the same. You may also find that if you're getting one of these, we actually have duplicated one of those older style W-2s. They're basically kind of a half sheet of paper, and you'll get multiple copies. Do not keep adding them in as if they have worked for the same employer and have 4 W-2s with the exact same amount. They're probably getting different copies of the same form. Generally on the form, they'll tell you which copy they have. We actually do not need to attach the W-2 to our returns at this point, but we may have a copy here that we want to retain for local. But all the information will be exactly the same. We're going to be taking a look at a couple different features. The first important one is understanding who the W-2 is issued to. So when we go into tax layer, we want to identify, is it going to be the taxpayer or the spouse? So we want to take a look at the name and make sure the name and address are going to match the records we have. Again, if we have information that's a little bit different, we want to make sure the W-2 is exactly as prepared. Last time we had talked about individuals may have an ITIN or a social security card that says valid for work purposes only. So that might be different than the number we're using on the return. We want to be sure the W-2 matches what the client is giving us. So at times, tax layer wants to try and put the information in. We can go ahead and override that by typing the correct information. So we just want to be sure the name, address, and social security number are accurate. We do want to be sure we enter the employer identification number. That'll be found at the top of the W-2. Good news is the first time someone enters a W-2, they'll have to enter all the information. The second time someone at that site enters the same employer identification information, all the other information will populate for the employer. So not to tell you when you want to volunteer, but if you don't like a whole lot of typing, maybe give it a day or two and see if someone else is entering W-2s for common employers. That usually works out pretty well, as long as they have all the information correctly. I do want to mention that the return information will show different numbers in different boxes. Big ones we're going to take a look at are box 1. That's going to be federal taxable wages. Next to that will be our federal tax withheld. 2 obviously important numbers to have. One is how much is going to be reported as taxable income. The second, how much was actually withheld for federal purposes. Now, tax layer is going to go ahead and make a presumption and try to autofill some information in. That may not always be accurate. So we always want to be sure that we double check the amounts are in Social Security and the Medicare boxes. For most of our clients here at VITA, we probably will not have people exceeding the Social Security withholding, because they'll be over the limit. But we may have some differences between federal and Social Security and Medicare wages, which could be some withholdings they have. So while tax layer may want to try and shortcut the process by autofilling, we just want to double check the input, make sure we have the correct numbers. You also see that there are a couple different boxes we have here as well. You'll see that there is some items here under box 12. So box 12 will have several different codes available. The predominant ones we'll see are maybe codes for retirement plan distributions, could be for HSA contributions. So those pieces of information will actually have their own code system in. Whatever you see in box 12, we'll have a line for those. Just go ahead and enter that information exactly as you see it. So if it says box 12A, code D, we'll just enter that number in right next to that line. Again, if you see things like the retirement plan box, we'll want to make sure that's checked as well in case the individuals are subject to retirement plans. Typically, the amounts on box 14 don't really go anywhere for VITA. So we'll talk to your site coordinators, but I wouldn't get overly concerned about box 14. Box 12 is much more critical than box 14. At the very bottom, I do want to point out that we do have your state and local wages. So here in PA, we have a little bit of a different tax structure. We don't exactly follow federal income tax because that would be way too easy. So we have our own unique concept of how we tax things in Pennsylvania. So oftentimes Pennsylvania wages may be different than they are for federal. So federal will give you a deduction for any amounts contributed toward a retirement plan. Pennsylvania does not. So your wages for Pennsylvania purposes typically will be the same as your Medicare wages. That's typically how Pennsylvania is expecting the W-2 to look. That may or may not always be the case, but again, we'll enter the W-2 exactly as presented. So we'll want to be sure we have the state wages entered, including the state withholding, and then also we can prepare the local return. So we'll want the local wages, local withholding indicated as well. It'll be important that we have a locality code in there to be able to get that to tie in for the local return. But again, we'll talk about that a little bit more as we get into the tax program itself. You may have an individual saying that the W-2 is not correct. We cannot change that at VITA. We are not in the capacity to change someone's W-2 for them. That's going to have to go back to the employer for correction. And it may happen on occasion, but just one of the things, if they say, I don't think this is right, they're going to have to go back and get that corrected before we can prepare the return. Yes.
I work at the King Street site, and it's not uncommon for people that make up to $30,000 a year to have no federal income tax withheld at all.
Yeah.
Is there any law that these companies have to withhold that? Because these people don't realize it, and then they're shocked. All of a sudden, they have a huge tax bill.
Yeah,
I've seen that multiple times every year.
Yeah, that's a great point. And unfortunately, I think we're seeing that more and more often here. Particularly, people have multiple jobs. If people have a lot of part-time jobs, the traditional withholding tables are basing it on the fact that that is their only source of income. So if you work for a part-time position and you're making $10,000 a year, the withholding table assumes you don't owe any income tax because that's beneath the standard deduction. So that employer is not going to withhold any tax. But if you have 2 or 3 other jobs also making $10,000 a year, they're not going to withhold tax either. So at the end of the year, we're probably going to have a lot of taxable income, but no withholding. There are some positions we can have. We can obviously not do much while they're here for the current year, but suggest that they update their W-4. So they're going to have to change the withholding with their employer. I've noticed over the past couple of years, we've seen a lot of the withholding tables are lighter than what they need to be. So particularly if people have other sources of income, if they have multiple sources of income, such as other wages, their W-2s are probably not going to have enough withholding. So it might be a suggestion to go back and have the W-4 updated with their employer as soon as possible so we don't run into that issue for yet another year.
But even, I mean, I can think of people that made $30,000 from one employee. Nothing was held, but there's no law that they have to.
There is not.
They're over the reportable income requirements, certainly.
Yeah. So when we take a look at how high the standard deduction's gotten now, we're over $30,000 for married filing jointly. So depending on how someone fills out the W-4, they may mark themselves down as exempt. They may have a couple other things. The W-4 has gotten a little bit more complex. If anyone's ever had to fill one out, it used to be fairly easy to just put your marital status and the number of dependents. I had a friend of mine put down 7 dependents, which was not a great idea because he did not have 7 children. And we had a surprise when it came to tax time, very similarly under withheld. His wife was none too pleased and was asking where the other kids are at. So we have to be sure the W-4 is how we control the withholding. It's just one of those areas where we've seen a lot of that in the past couple of years. I think probably the last 2 to 3 years, particularly at VITA sites, we've seen a little bit more of an uptick in balances due or greatly reduced refunds because they don't have sufficient withholding on their wages. Okay. Yeah. Great question, though. Yes, John.
On the W-2, the business address has changed. Did you change it?
So if the business address for the employer has changed, are you talking about if it's pre-filled or if it's pre-filled? And yes, so I'd want to be sure we're replicating what the current W-2 shows. What's going to happen, these files go electronically to the IRS. The more information they have to match up, the better that's going to be to avoid a future notice. So if that address, when you put it in, if you put in the employer identification number and it pops up and it's showing something other than what the W-2 shows, I would recommend updating it to reflect the current W-2.
What about the person's address? They've moved, but it's the W-2 issued to an old address.
Yeah, so that's always a unique question because what's going to happen is TaxSlayer is going to pull the address that we have on entered in the very beginning sheets. And as we mentioned last time, we want that to be the current address. So that way the IRS is updated. Technically, we should change the W-2 to the address shown on the W-2, which isn't great if people have moved around quite a bit. But any advice from the site coordinators? Are you having it?
I don't change it.
You
I don't change it.
Okay. All right. So to be determined. You don't have to change it. The standard practice recommended is to change it, but it works without it.
I always figured the IRS is chasing them on their social security number and on the employer ID.
Great.
And they've got some file at the IRS with addresses and everything else.
Yeah.
And employers can have multiple addresses on the W-2 and the same employer ID.
Correct.
So if you update it, then the next person that uses it may be having another address.
Oh, sure. Okay.
So I recommend we don't change the employer name and address.
But as long as the employer ID number is the same.
Employer ID is
So
critical.
you know it's live.
Yeah, the employer ID, yes.
All right. Great. It's always good to get some advice from the field here. As long as the numbers match up, the IRS should be able to identify it. Again, we're not teaching you keyboarding skills, so you don't have to do excessive typing if you don't want to. Yes.
I have a question on the local.
Yes.
Sometimes, like people from the hospitals, the local doesn't match anything.
Oh, okay.
It's not the Medicare or the wages.
All right.
Different amount.
Gotcha. So that is a unique question that we do have that certain payroll providers may have a completely different number than what we're expecting. Or I'm glad you brought this up because it could actually happen if we have someone who moves locations throughout the year as well. So unfortunately in the local box, they may throw more information on what they truly need. So sometimes we'll see things like the LST show up in there and a $52 withholding. That's not the right position for it. That should have been in box 14. But we do have a situation where we have differing amounts. So the question is, can we reconcile where that's coming from? You know, is there something that we know that the local wages are supposed to be different from PA and from Medicare? Sometimes it's a mistake on the W-2 that they just didn't have enough withhold. So kind of the question that we run into is we can file it as is, but then typically the Lancaster County Tax Collection Bureau will come back and ask, why are they not the same? So again, Mike, do you want to?
Well, Lancaster General seems to be the worst. If an employee works at multiple locations, all Lancaster General,
Yeah.
Lancaster General believes you have to have a local withheld for each one of them, and they'll list them all separate, and they don't add up.
Oh, okay.
You add the wages up, it doesn't come back to the state wages.
Okay.
And we usually end up telling the client, we've done the best we can, but you may get a letter from the local people.
Okay. So in that instance, are we using then the same wages that the Medicare shows, or are you adding up what the numbers are on the local box?
Sometimes all we can do is add up what's in the local box
Okay.
and say, we don't understand why your local is different than Pennsylvania.
Okay.
You may get a letter from the local people questioning that.
Okay. Gotcha. So the recommendation is we'll use the numbers on the local W-2, including the local withholding and the local wages, so that at least ties out to the W-2. Okay. Sometimes if you know that if there is an error, you know, I've seen it before where they deduct things that aren't supposed to be deducted. Local is our lowest tax rate. So again, if you have an issue, probably contact your site coordinator. If anyone's here from LGH, that'd be great for us to have a conversation if you want to let us know your payroll person. Yes, sir.
Just to clarify, so if they had the LST, the $52 in class 19, we just ignore that.
Correct, right. So I have seen employers that are using these additional lines. So where you may have two city wages or local wages. One's going to be the income tax and one's going to be the LST. They're not going to tell you which one it is. But if you see almost the same amount of wages, but $52 of withholding, they put the LST down there. Most payroll companies should be doing a pretty decent job. However, they're going to be a little probably busier than normal this year with trying to figure out a couple other items to how to disclose. From our information, the W-2 will not be showing information that we'll need for the other deductions. So the IRS will not be revamping the W-2 for the current year. You may have heard, and we'll talk about this for the overtime compensation and for tip income. That is not going to be reflected on the W-2. We're still waiting to hear how that's going to be reported by the employer. Most likely we'll probably get a supplemental schedule, which is going to show the eligible tip income and overtime compensation. But the W-2 for 2025 will not be substantially modified. Yes.
Just to confirm again, if the client's current address is different from what's on the W-2, are we to correct the W-2 or just let the taxpayer bring that address over?
All right, so we'll give you two answers here. The tax layer answer is correct it. The practical answer is it's going to be fine. You don't need to worry about that. And in case you have any questions, Mike is right here to help address any of that.
Sorry, I never heard it came back as a problem.
Yeah, I think that's the least of the IRS's concerns, as long as you have the income reported. As we mentioned, theoretically, having the correct employer identification number and correct social security number should be sufficient for the IRS to match those numbers together. Yes.
Regarding the LST, I would not ignore that. It does not show up in tax layer. However, if their income, total income is less than 12,000, they can refund that LST by filing a local LST return.
Correct, right. So that would be an option when we talk about the local returns, that they may have the ability to have the LST come back. One other thing I do want to mention about the local returns, if you have preparing a return for a child who's under the age of 16, they are not subject to local income tax. So that might be another situation where their local does not match state or Medicare. Once they turn 16, they're supposed to start withholding. I usually, for the local return, will put a little note on the local return, their date of birth, or they turn 16 as of that date, so we don't get any additional notices. Hopefully the employer, if they know they're going to make less than 12,000, will not hold LST, but if they do, they can get it back. Similarly, if they have an issue where they have multiple employers that have over withheld LST, there's a form that they can file as well if they want that to come back. Yes.
Often I see in box 7, the Social Security tips, there can be a number in there. But this year, I mean, should we just report what's in there and then this other form will take that into account? Or?
Well, yeah. So another good point for people who work in service industries that may have tips, usually restaurants will have amounts reported in Social Security tips box 7. Social Security wages will be lower. So you want to fill out the W-2 exactly as shown. So the Social Security wages will be low. You'll have to go ahead and override the number on the Social Security withholding. Then you'll get one of those fun diagnostics from VITA or the tax layer program to say, are you sure that this W-2 is correct? Yes, it is. I've looked at it and I've typed it in. But yes, so that box 7 is actually not going to be what's going to necessarily trigger that tip deduction. It may be useful. Some employers may just say, well, we'll use that one. But we'll want to be sure that all the W-2 information is entered exactly as shown. Yes, sir.
Just one other thing. Many times the federal employer identification and the state are different.
Correct.
They just need to be entered correct.
Yes, that's a great point. The federal identification number should be a 9-digit number. Generally, it's going to have a 2-digit prefix with 7 behind it. Generally, around here, we probably see a 2-3 or a 3-6 to start. Could be anything at this point. But the state number is actually different. Should be an 8-digit number, 4 digits of space, and then 8 more. There are some employers that, for whatever reason, still put their employer identification number instead. But yes, so we definitely want to make sure that the W-2 in tax layer looks exactly like we have it, with the exception of updating a couple of the addresses. So we're okay on those. Okay, other W-2 questions? And again, these all come in different varieties. This one's nice because it's a large print edition. You'll see some coming from ADP that are smaller. And sometimes what I like to do is if they give you that summary in the larger box, that actually works a little bit easier to read some of those numbers. One of the things we've taken a look at with my teaching materials at eTown, one of the publishers has a little clip art that goes with some of the accounting, and they show an accountant with a magnifying glass. And I said, all right, I'm a little offended because it seems like we all have to carry magnifying glasses until you try and read some of these W-2s, and you're like, oh, all right. Subtly, if you don't have a magnifying glass at your location, we can show you how to use your cell phone to go ahead and take a look and make sure you have the accurate numbers. Yes?
2 things, and this may be a local section when you do it, but I think this year anyone living in Lancaster City is going to probably have to be owing local tax because they raised it to 1.6, almost the same as Solanco. And I do carry a magnifying glass.
All right, wonderful. Okay, all right. All right. Hopefully, I don't know if we'll have to take a look at some site funds if we can come up with magnifying glasses for the tables. Some of these do get a little bit small. Hopefully, most of these are still going to be actually computer printed. On occasion, I have seen a couple of these that are still handwritten. Hopefully, we don't have many of those anymore, or typed in on kind of that eggshell paper that somehow the typing gets off-centered a little bit. If you can't find it on one version, hopefully you have a couple other copies of that W-2 to find the correct numbers. Just bear in mind, 8s and 6s can look somewhat similar, so make sure you're comfortable with the numbers. Okay. Other questions on W-2s? Again, for the new people, we're not going to scare you. The W-2s are hopefully pretty straightforward with these. Okay. Couple other ones that we want to take a look at here are going to be our 1099 series. So that includes the 1099 interest income. So the IRS actually does a pretty good job of naming these forms. So the 1099 is an information form. The INT will stand for interest. So they're pretty good at doing abbreviations. So the interest form is going to have a couple pieces for us to take a look at. We may see a little bit more of interest income being reported just because the interest rates have been high for the past couple years. If people have a little bit of extra income, maybe they have it, particularly if they have money with a credit union or other type of savings type of account, we may have reportable income. If they come and they say, I don't know why my bank didn't report my interest income, I brought in all my bank statements and here I have interest of $3.26 at the end of the year, we have a $10 threshold. That amount is actually not going to be reported to the IRS. You are more than welcome, if you like, to put the $3.26 of interest income in. It hopefully should not impact the return tremendously. But typically, you're only going to get a 1099 INT if you have $10 or more of interest income. A couple things to just point out here. The predominant one we'll probably see is coming out of box 1, which is our traditional interest income. If there is any amount for an early distribution or early withdrawal penalty, that would be in box 2. That's typically if you have a timed account, like a certificate of deposit that you've taken out early. That is going to be actually a deduction on the return, but if you enter it in TaxSlayer, it automatically goes to the correct portion. Anything that you have for interest on U.S. savings bonds in box 3 would be taxable for federal purposes, but not for state purposes. And we may talk about a state adjustment to make sure it's coming over correctly. Okay. Any questions on interest? Yes.
Is the $10 threshold per account or total for the return?
It's per account. So you may have banks, and if you've been in Lancaster County your entire life, you may see people that have banking relationships at 12 different banks because they all started at little ones and they branched out and they come back together, but they have accounts everywhere. And it's $10 per bank or per institution for the filing requirement. So theoretically, if you have 8 different accounts with $6 each, you'd have $48, but the IRS will not get a 1099 INT. So if you want to, you can go ahead and disclose those. But the IRS doesn't know the information. The client's basically going to have to tell you about that. But usually I hear it because they say, my bank's messed up this year. I didn't get my form. Well, the bank doesn't really want to send out a form for less than $10 anyway. Okay. Along the same lines of investment, dividends and interest. So dividends will be in the same input area for the interest accounts. These are the 1099 DIV, standing for dividends. If you ever get a form and you're not entirely sure where to put it in, if you take a look at the search bar in the upper left-hand section of your screen, you can just type in 1099 DIV. It's going to take you to the input section. So particularly if you're new to TaxSlayer or you're not as familiar with the form, use that reference to go ahead and find out where the input should be made. For dividends, we're going to see a couple different features here. So we have ordinary dividends. That'll be the total amount of dividends that the individual will receive for the year. But there'll also be another box called qualified dividends. Qualified dividends are basically dividends paid because the individual held the security for an appropriate amount of time. Qualified dividends can actually have a special tax rate, which is as low as 0% for people here at VITA. Same thing with capital gains. You'll see that on box 3. The more complex you may have with the 1099 DIV, if it's just an individual security, it's probably going to be relatively straightforward, but you may see these coming from brokerage accounts. Someone may have mutual funds or multiple accounts. So we just want to make sure that those are actually set and entered exactly as shown. But however, I just want to mention that the qualified dividends can be as low as 0%, especially here at VITA. Same thing with capital gains. So if you take a look at the return and you see there's taxable income, but there's no tax, maybe the software is glitching up again a little bit, but more likely than not, it's probably actually going through the correct calculations and doing that we have zero taxable income on qualified dividends and capital gains. There are a couple other features in here too. Section 199A dividends, those are probably going to come through from mutual funds. Those also have a special tax calculation as well, but we don't have to do anything special with those. For the majority of these forms, once we go ahead and see the information, we put it into the system, TaxSlayer will automatically calculate and determine where they should be presented on the returns. Okay, a couple other things I just want to mention. Talked a little bit about unemployment compensation earlier. So this is one that we unfortunately see a bit. I should probably make sure this gets updated. For those of you who have done unemployment compensation, you're like, why does it say 1 Commerce Street? Everyone knows it's Boaz Street up in Harrisburg at this point, right? We almost memorized the employer identification number for the state. Unemployment compensation is taxable. So if you're getting paid to not work, but you're able to work, that's taxable compensation. For federal only, PA does not tax unemployment compensation. But if you do have an individual who is getting unemployment compensation, they're hopefully going to bring the 1099-G in. Again, it's a 1099 form, so it has to be reported on the return because the government also gets a copy. The government's very good at matching. That's one of their, despite just abbreviations, they're also good at matching numbers. So they're going to get a copy of these forms from the issuer as well. So once a return comes in for processing, they'll process a return. A little while later, they'll double check all the information to make sure all the information that they have received is also reported on the 1040. So it's important if someone brings a form in and has a 10, a 0, and 2 9s in it, that somehow ends up on the return. So again, I just want to be sure we enter those appropriately. Because this is going to be taxable income, hopefully the individual has withheld federal income tax. It's generally by default 10% is what they typically would withhold, which is good because they probably need some withholding in order to help maintain their refund. Another one that is hopefully no W-4, and that one is just whether you're elected or not of the withholding process. Okay, how are we feeling on unemployment compensation? Any questions or concerns there? Okay. The next one is one of our other large ones, is our Social Security form, the 1099 for the SSA. So what we're going to see is most of our retirees will be receiving these forms if they're getting Social Security. The amounts that we're going to take a look at, again, identifying whether it's for the taxpayer or the spouse. A couple pieces we're going to try and pick up. The big one is going to be the amount that's in the salmon color box. Like, are we okay with that color scheme? If anyone's seen it, it's if salmon's not the right color, let me know. I'm not the world's best. You know, it's trying to like determine what color gray is going to go on the wall. It is, you know, but I think it's somewhere in that color range. It's going to be the box in the upper right-hand corner there, box 5. It's going to be our net benefits for the year. TaxSlayer does a very good job of entering the information, so you can summarize it. You can also pull in the amount that they're going to pay for Medicare. So your Medicare premiums are also going to be entered in. That would be useful if they're going to itemize deductions. So we'll talk about itemized deductions the next time we meet, but you can enter your Medicare premiums in as well at the same input of the 1099 SSA. If we have any unique situations such as lump sum withholding, we actually do have, or lump sum distribution, we do have a special section in the 1099 SSA for that. Generally, it only happens if someone has gone through an SSA appeal procedure and they have some back Social Security that they're getting paid all in 1 year. We do have that ability to go ahead and push that back to prior years to smooth out the tax impact. Again, kind of a unique situation. And if we run into it, just want to be sure you have the resources, the 4012. And if you have any concerns, be sure to ask someone at a site. We've seen that before. And Mike, I think you've done that before. Multiple times. Okay. So if you have any specific questions, we'll hopefully have a lot more answers at the site of how to go through the lump sum distribution. Relatively basic process if we have the information. We need their prior year returns to be able to help complete that, but really helps out from a tax liability perspective. We can run it both ways to see if it makes sense or not. Okay, good news for Social Security though. All we have to do is put the information in the return. The tax system will determine how much of any Social Security will be taxable. Just for your edification, Social Security can be as low as 0% all the way up to 85% taxability. Good news is most of our clients will not be in the 85% category, but depending on their other sources of income, it could be a little bit higher. We sometimes run into that issue if people now go back and take a secondary job. Maybe they have some additional income coming from a investment account or something else that may cause their Social Security to go up. The other thing that we often run into, and we'll talk about in a little bit, is gambling winnings. Unfortunately, gambling winnings, while it may sound exciting when you win it, may have a lot of additional tax consequence that you may not be prepared for. But we'll talk about that in a little bit. Yes, sir.
I don't know if you want to mention this now, but the last session you mentioned there's a $6,000 deduction for elderly now. Is that affect Social Security? Like who pays that, or is it?
Yeah.
So wait till next time.
No, so that'll be in our next section. We'll talk about our new deductions. The premise was that the political campaign was basically everyone was saying no tax on Social Security, and sounded wonderful. What a way to get people to the polls to say no tax on Social Security. However, it's not actually permissible to not tax Social Security. So the workaround was actually a deduction for seniors 65 and older, whether or not they actually get Social Security. So that is actually, so a couple of these things we talk about, the no tax on Social Security turned into a deduction for individuals age 65 or older. The no tax on no tax on tips, no tax on overtime is actually a deduction against income if we meet certain qualifications. Good news is for VITA, there'll be some thresholds that'll be in there. The VITA clients will be underneath all of those phase outs. TaxSlayer should be getting that to work effectively once we're all up and running. But the phase outs really should not be applicable here. When we talk about those, and we'll cover those after Thanksgiving. So we'll be well fed and well ready to go.
So after a certain income level, it's less than 6,000 to the point where it's not, you can't deduct it at all.
The phase out's pretty high. I had the opportunity to run through a couple of those scenarios with some students this semester, and it phases out pretty high. You get that for quite a bit. So the deductions and credits that we'll talk about next time have some unique elements to them that the credits and deductions are intended to benefit certain taxpayers. So generally, they're trying to look at lower to middle income taxpayers, and they don't want to reward people with high AGIs. So that's why we have some phase outs. Fortunately for VITA, with the $70,000 income limit, we won't really be hitting those for the individuals. So the good news is where we talked about the people that don't have enough withholding, if they're 65 or older, they may now have a benefit of an additional $6,000 per individual coming off their taxable income.
Per individual.
Per individual.
So a married couple would be 12,000.
Yeah. Yep. So, and that's it. You can only have your spouse. You can't have multiple spouses and try and get higher than 6. So we haven't got to that stage yet on the returns. We haven't figured out that filing status.
How about you, Todd?
Yeah, well, we haven't gone quite to the multiple spouses. Okay. Other questions on Social Security? Okay. Let's go ahead and take a look here at a couple other features. Another big one we have, so again, depending on your site, for those of you downtown, you're probably going to see a lot of wages and also Social Security and retirement plans. For those working out in some of our retirement facilities, this is your world. This is going to be the 1099 SSA and also the 1099Rs. 1099Rs are reporting any retirement distribution. So these could be from pensions, annuities, they could be from 401ks, IRAs, a whole host of any distributions coming out. Again, we just want to make sure that the information that we're getting is reported correctly. So I'll go through, and I have a couple pages to talk about because these are a little bit more unique because there could be a couple different presentation methods for the 1099-Rs. And again, first-time volunteers, predominantly everything comes through very, very nicely. It typically is going to be a taxable amount. That amount that we get for the gross distribution will be the same as taxable. Hopefully there's some withholding, maybe, maybe not. And we'll see a code 7 in box 7. And then we'll talk about a couple things that are not quite the same. And if you're wondering, what are we talking about these codes? Well, this one has some codes in box 7 to help indicate how the distribution should be treated inside the tax layer program. Again, we don't need to go ahead and kind of memorize what these codes are or how they operate, but I'm going to give you the code here on the next slide. Also, it's going to be in your 4012. It's also going to be on the back of the 1099 or at the bottom, depending on what kind of copy you get. But here you'll see in the middle of this on the screen, you'll see a distribution code, code 1. Again, we should probably update this to not have the scariest code up there when we're talking about the codes. I'd prefer to see a code 7 and we're good to go. Nothing to worry about, nothing to see here. But let's go through a couple of those codes. The first one you see that we show up there is the code 1. Code 1 is usually my indication that if we have a box of tissues nearby, I should start locating that and getting it ready for the client. What the code 1 means is it's an early distribution from a retirement account. The individual is under age 59 and a half, and there's no known exception. Well, what happens? It means that that entire amount is going to be taxable and also subject to a penalty of 10%. So what typically happens in these situations, we have an individual who's probably separating from service, that they had some money in a retirement plan, and as they go through the exit interview, they have a conversation and they talk to the benefits coordinator and they say, we still have a 401k with the company. Here's some choices you have. You can roll that 401k to your new employer. You can roll the 401k over to your own plan, such as an IRA, or you can take the cash. Most people forget hearing the first two options and they hear, you can take the cash. Well, that sounds kind of enticing. I can take it? Sure, you can take it. They probably also tell them that we have a 20% withholding on that, which you can, normally is mandatory, but you can opt out of that if you want. Do not opt out, because not only is that amount subject to income tax for federal purposes, can also be subject to state and local taxes as well, and will be subject to a 10% penalty unless an exception applies. So the reason why I say get the tissues ready is generally it means that we're going to see a higher amount of income being taxable. And if they didn't have the appropriate amount of withholding, could indicate a balance due. And especially when we get to the state and the local position, they may have some balances due. Okay, yes, sir.
What, I mean, the state is taxing money contributed to IRAs, isn't it? So why would you get taxed again at the time of withdrawal?
So yeah, it's a great question. So when it comes to the taxability at the state and local level, the reason why we see a difference on that W-2 between federal and state wages is that the state is not going to give a deduction for your contributions to a retirement plan. So if you have a 401k and you put $5,000 a year into the plan, your federal wages will be $5,000 lower than your state. So what happens when we take money out of the plan, the state's going to give you your first $5,000 back tax-free. You never got a deduction for that amount going into the 401k plan, so that amount comes back tax-free. But the issue is if you put $5,000 in your plan and you took $6,000 out, the state views it as $5,000 is your money and $1,000 is earnings. Now the earnings, because it's an early distribution, is going to be considered taxable compensation. So the state's going to tax out of that $6,000 only $1,000. You're going to get your $5,000 contribution basically as a tax-free return.
Say you were contributing to that IRA over like 10 years. The
Yeah.
state was taxing that over the 10 years, but it seems like it's already been taxed.
Well, so the issue that we have is PA has what we call cost recovery. So it means that you can recoup any of your investment into those retirement plans before it becomes taxable. However, we need to go ahead and figure out how much you actually have in contributions to that plan over that period of time. If it's relatively recent, it's pretty easy for us to go back and get the W-2s. The way I usually do it, if they've only been with the employer for a year or two, take a look at the W-2, take a look at box 12, whatever's on code D, that's the amount that they contributed. I can subtract that from their 1099-R for PA purposes. But any of the earnings on it would be subject to tax. If they lost money on it, they don't get that as a deduction. Yeah, so PA is a bit unique, and we'll get to hear more about that a little bit later. Yes, John.
So, using your example, Pennsylvania's gonna tax the full 5,000 unless you go into TaxSlayer and tell it, only to tax 1,000.
Correct.
So you have to do something.
Yes, you have to do something in TaxSlayer to tell it how much the taxable amount is.
If the taxpayer doesn't know that information, then we're going to not do anything.
Well, okay, so we'll give you a little basic information. If the taxpayer has a number, we'll typically use the number as long as it seems reasonable. If they don't have a number, we cannot provide the number for them. So there's ways that we can go back if they have resources available. For example, if they've only been with the employer for this year and maybe the prior year, and they happen to bring their prior year return in, and I can see from the W-2 that we have their contribution, and we can ask, are these the contributions you made? And they're like, I have no idea. You're like, great, we'll go with that as your answer. I'll take the amount that you have on the 12D as your contribution. So if I have evidence, I can go ahead and put that in. But typically, I'm going to ask the client for those. Now, generally, we're also talking with the client who never heard the other options they had about rolling it over to a new plan or giving it to their new employer. They just heard take the cash. And then at some point, they realized they could take the 20% withholding off and get more cash than just 80%. So the likelihood that they know exactly how much they put into that plan is fairly low. But we can also say, hey, can you go back and just pull in your couple years of returns so we can see what your contributions were? They're generally going to be receptive to paying less tax if they can come up with more information. If they don't have it, we can certainly just put 0 in as their basis. That's probably not the right answer, but it's an answer. The state doesn't mind that answer to get a little bit more tax. But yes, we have to physically go ahead and put in a different number in. Yes?
The other problem is they will not be deducting it with anything for state tax, so it's all on them on that profit.
Right. So yeah. So if we take a look at the cost recovery, any amount that they've earned above their contribution would be taxable. So they need to prove how much they actually put into the.
There's no withholding, so it's all on them.
There's no withholding. Correct. Yes. So most plans, and another great point, there is a state withholding box that we have on the 1099-R, very seldom used. Because if it's a normal retirement distribution, PA is actually very fortunate for retirees, other than the weather, obviously. This is not a great day to be here in PA and as a retiree having to scrape off your window to come to a VITA training. But otherwise, it's a great state for retirees. They don't tax Social Security, they don't tax pensions, they don't tax retirement distributions. So the most of the providers do not have state withholding on their retirement distributions. However, you do want to make sure, I have seen situations where for whatever reason, particularly if it may be a one-time distribution, they have had state withholding. So just, I take a look at it, I normally just go right off the federal and I'm good. But always make sure you're double checking the form to make sure all those boxes are filled in. Typically, they won't see any state withholding. Certainly on a early distribution, we probably won't see any withholding at all. So yes, it would be up to the taxpayer to have to pay those in on their own for state and for local. Okay. So I started with the worst code first. Hopefully it gets better from here. Because code 2 is actually going to be an early distribution, but an exception applies. So typically what you're going to have is maybe a withdrawal coming from your retirement account, and you've actually provided a valid reason why that withdrawal is coming out. It could be due to divorce or a QDRO situation. It could be another type of allowable distribution. You're under 59.5, it's still taxable. We didn't get rid of the taxability. It's just going to be whether or not you're subject to penalty. A couple other things that we'll see here for death and disability, 3 and 4, mean that it will be taxable for federal purposes, but no penalty. Now, 3 and 4 are also not taxable for state. So, as I mentioned, where you have that inheritances are not taxable, if you actually inherit an IRA or retirement plan for someone, the general rule is that you won't pay tax when the monies are transferred, but you have to pay tax when you withdraw those funds. The new rule for IRA inherited balances is typically that has to be withdrawn within 10 years after the date of death of the owner. So we may see younger individuals who are taking money out of these retirement accounts. As long as it's coded as a box 4, you should be in good shape. It's still going to be taxable for federal purposes. It's still going to be taxable monies, but it will not have a penalty and it will not be subject to state tax. Again, we just have to double check that the reporting is done correctly. I have seen clients that they have inherited IRA, and for whatever reason, the provider knew it was inherited IRA. They issued a 1099 with a code 1. We can't fix that. We should have them go back and try and fix it. Although we've also heard some stories that the providers are like, well, too bad, we can't go back and correct it. Then we have to make our best decision possible about how we want to handle the return. But if we know the 1099-R is prepared incorrectly, we should send it back to the third-party administrator for advice. Now, there are a couple other things I just want to mention. The good one here is code 7. That's a normal distribution. That's going to be where an individual is taking out their, whether it's an annuity, a retirement distribution, IRA, it is part of their normal distribution process. It's going to be taxable for federal purposes. For PA, if it's a normal distribution like a code 7, not taxable. So we're going to be okay. Hopefully we have some withholding to help offset any tax liability. The other ones, I'll mention a couple of these letters next because we could have used all letters, but they wanted to go with numbers and letters. So we'll mix and match these things. The G's are typically a rollover. So that's the option where we said if you want to take your plan and roll it to another, maybe you're consolidating accounts, that's a tax-free rollover. So as long as the code G's in there, we should be in good shape. Another option we may have, hopefully the taxpayer doesn't do this, that they take the money out themselves and put it back into another account within 60 days. That's a rollover, but most likely it won't be coded that way on the 1099-R. I have a couple that are highlighted here in red, the code 6 and the code W. These are actually tax-free exchanges. So they're going to be a tax-free exchange of an insurance or annuity. So you're basically just changing an annuity to another annuity. Same thing with the code W. Again, enter those in federal exactly as you see them. The reason why they're red and with an asterisk is because they have an implication of PA. They're not taxable for PA purposes, but technically we have to add those back for the PA tax forgiveness and rent rebate program. So those are additions to the PA rent rebate and the PA tax forgiveness. So I just want to mention those.
See if they qualify for the less than 45,000.
Right. So that'll be added into their other income. So unfortunately, that might be where they're using the, you can use a retirement plan to pay for long-term care insurance premiums, or maybe you've changed an annuity contract. That will be considered not taxable income for PA, but it will be added to your rent rebate and property tax.
Qualification. Yeah.
Correct. Yes.
I have a question on the 2 for the early distribution exception.
Absolutely.
I've had some people with rent,
Okay.
so it's not a mortgage, we're behind in the rent.
Yeah.
And, I don't have any money, and so I took money out of it. Does that count as an exception?
Yeah. So there was a new change to how things have come through. We now have what we call an emergency fund coming through. Usually code 2 is probably you're going to your employer and you're telling them you need an emergency withdrawal from your fund. So typically those types of things can be considered a permissive distribution. So you can take up to a certain amount out to pay for things like to stave off eviction, to maybe replace a heating or an air conditioning unit, emergency type purposes. So we'll talk about that a little bit when we get to the penalties. But yes, so typically if we see a code 2 there, that means the third-party administrator has gotten a valid reason why they're taking money out of their account. It's still taxable, just not subject to penalty. Okay. Does that help with that question?
Yeah, I'm thinking rent and food may,
Yes.
especially now.
Yes. So those would all be considered. So they added the emergency withdrawal to retirement accounts. So that is considered a permissible distribution to avoid penalty, but still subject to income tax. Yeah. So those are the kind of things. If there's an emergency situation, usually, like you said, food, clothing, keeping a roof over your head. if it's, I need to get to the beach, that's probably not an emergency. I need a mental health day. I don't think that's going to count. Or, the kids really need something for the holidays. Probably won't count. Yes.
Would an inherited IRA also have to be added back into the tax forgiveness? And would that be the code for?
The code for, so technically, the inheritance gets added back when you receive the balance. So not when you take the distributions from the account. So PA, property tax rent rebate, and the SP both are adding back in gifts and inheritance, but it should be at the time that you actually receive the funds, not when you disperse them. So if you get, let's just say you inherit from your grandparents $20,000 in cash and a $10,000 IRA, at the time that you're getting the $30,000 inheritance is when you'd add that to the SP and property tax rent rebate. When you're taking it out, it should not be hit twice. So it shouldn't be considered income a second time from that perspective. At least that's what I've been taking from the instructions. So Mike and I will be in the same position with the state. So, yeah, right. Okay. Yes.
The chart shows the state and local tax. Which codes are taxable at the federal level? You mentioned 3, 4, and 7 are taxable at the federal level.
Yeah. So generally, all of the numbered ones are going to be taxable at the federal level. We have a couple of the lettered ones that are going to be exempt. Predominantly, the direct rollover is going to be exempt at the federal level. So these are going to be the ones that we go ahead and the numbered ones typically are going to be taxable. The lettered are going to be non-taxable because it's going to be a qualified distribution from a Roth IRA or a rollover. So the lettered ones are typically okay. It's going to be the lettered ones that are typically federal taxable. And we'll talk about a couple of these in a little bit. Looks like Edward's getting ready to set up for a break here. Do we want to take a quick break now and come back and finish off a couple of these things? Or because we'll have a couple more slides on pensions and annuities. So I just figure we could probably, are we ready for a quick break? Okay. All right. Looks like coffees are ready and loaded to go. Looks like we have some more carbs and sugar back there for getting through the remainder here of the pensions and annuities. So we'll come back and talk a little bit more detail on these topics. All right, everyone. I guess we'll try and get started here for the remainder of the session. So great comments, great questions we have here on the pensions and annuities. This is a little bit more of a unique element, so there's a couple more things I just want to kind of address here with pensions, just to be sure we're kind of clear. As we mentioned, the codes that you're going to see here are going to be populated. Now, what's very unique is we may actually have 2 codes in the box as well. So we'll see at the very bottom of the sheet here is a code that has called 7D. That's going to be a distribution. So the code 7 means it's a normal distribution, and the code D means it's coming from an annuity. In this case, it's a non-retirement annuity. Now, TaxSlayer will go ahead and pick all these codes up if you put them in correctly. Now, the issue is not all the third-party administrators put the code in directly. So if you see something that says a D7, just reverse it. It should be a 7D. So TaxSlayer knows how to work with a 7D. They have no idea what a D7 is. So if you see the letter before the number, just switch those around. So while the third-party administrators should be pretty much adept to what they're doing here, every once in a while we see ones that aren't coming through the way that they should. So just want to talk a little bit more about a couple of those codes. So again, the 7D is going to be one that we have for non-retirement annuities. So what this basically is, we're seeing annuities kind of rise in popularity as people are now looking at those as an alternative investment. What it basically is doing is you're going to give a lump sum of cash to a investor. They're going to go ahead and give you amount of money over time, whether it's a lifetime or whether it's a sum of years. Part of that will be your own money coming back. So what we're going to see is that we're probably not going to have the same amount in box 1 as a gross distribution as what you're going to find in taxable distribution. Hopefully that provider has gone ahead to make the difference. So if there's nothing in the box for the taxable amount, we're going to presume it's going to be the same, and I'll go through that in a little bit. But if there is a difference between the gross distribution and the taxable amount, we want to enter the 1099-R exactly as presented, particularly where you see annuities. That should be a difference between the taxable and your gross distribution. Now, the amount that is shown as a taxable amount is also going to be taxable for PA. PA does not treat non-retirement annuities the same way as other retirement income. They believe annuities are an investment product, not a retirement product. So that's why 7Ds will be taxable for PA. And before we get concerned and say, oh, I haven't done that for the past couple of years, good news, we can start doing it now. And just tell our taxpayers that it is a taxable situation for PA. And I believe if you put the 7D in, it does go over, Mike, to PA.
Yes.
If you put it in D7, it will not. So we just want to be sure we have the right amount. It should carry from the box 2A. Another one that we may see, although probably a little rarely here in VITA, would be a Code F. That is for a charitable gift annuity. If anyone's interested in doing a charitable gift annuity, and we may or may not see those within VITA, that is also considered a income for Pennsylvania. So whatever the earnings are on that charitable gift annuity would be taxable for PA, effectively as interest income. Same thing with the 7D. As I mentioned on the Code 4, again, it's a distribution to a beneficiary. No early distribution penalty for federal, even if they are under 59.5, and is not taxable for PA. So I just want to, again, go back to that Code 6 and Code W, the additional details on the insurance contracts. Just a little bit more information. I just want to expand on that a little bit. The Code 6 is basically a tax-free exchange of life insurance or an annuity or a long-term care contract. That is going to be reported on 1099-R. Whenever you have a change in insurance or you have a distribution from a retirement type of account, a 1099-R will always be issued. So no matter what that consequence is, we'll see a 1099-R be issued. It just all depends on what the code is. While this is happening, again, it's not going to be taxable for PA purposes, but it may have an impact here on the SP and PA 1000. Same thing with the Code W. Code W is going to be a amount that they're pulling out of a account for purchasing long-term care insurance. Code W is actually not taxable at all for federal, state, or local purposes. Not taxable for income. But again, can have an impact for the PA tax forgiveness and rent rebate. What I should probably have started with here is what actually are pensions and annuities. So pensions and annuities are going to be payments coming from any type of retirement type program. That includes our 401ks, 403bs for those in the government or nonprofit sector, and government 457 plans. So these are all very similar type retirement based plans that typically you're putting money in during your working years. You may have a match from your employer, and then when you hit retirement, you can take distributions out. So generally, for federal purposes, these distributions are going to be fully taxable. You got a tax deduction on the way in, so we reduced your taxable income by the amount of the employee contribution. So what's building up in this account was a tax-free or tax deductible contribution, or money's being put in by your employer, or tax-deferred earnings and growth. So once the money's come out, that should be taxable in full. And that's generally how we're going to see these. If you get a 1099-R and you have an amount for gross distribution and the code says 7, normal distribution, they didn't leave anything in the taxable amount, we're going to assume that the gross distribution is fully taxable. Now, there's a couple exceptions that we have for insurance premiums. So we have retired public safety officers or PSOs. We do have the references here, again, as long as this didn't change. We actually have a pretty nice section in here. The 1099 input screen is going to have the opportunity to put in a deduction for any insurance plans paid for retired public safety officers. So that includes anyone who is a law enforcement officer, a firefighter, chaplain, member of a rescue squad or ambulance crew. So these are people who are now buying supplemental insurance. Has to be made directly from the plan, directly to the insurance provider. And so that would be up to the amount of your distribution or $3,000, whichever is lower. Now what we're going to see on the 1040 is we're actually going to see under that boxes, we're going to see a couple different check marks. So if anyone had seen the PSOs before or the qualified charitable distributions, it's going to be much cleaner now with the 2025 return. There's actually going to be a checkbox on the front to indicate whether or not that we're reducing some of these taxable amounts by a public safety officer or QCD. We may have partially taxable annuities, as I mentioned, particularly on an annuity itself. We may see that part of that's a return of capital, and that should be shown in part box 2A. So typically, I'll talk a little bit more about box 2A here, is that's the amount that's going to carry to the Form 1040, page 1, line 4B or 5B. And the reason why it's going to carry to one or the other is whether or not on the 1099-R, the box is checked next to the box 7 to say whether it's an IRA, SEP, or simple. That just indicates if it's going to go on line 4B or 5B. So if there's a taxable amount in 2A, we're great. We're just going to enter that amount. That's going to be what flows over on the return. If there's not an amount in box A, and that could be that it says unknown or it just stays blank, this is where we have a unique question. So what we're going to ask the client is, did you make any contribution to a retirement plan with after-tax dollars? And I'm hoping for two answers. One is no, or there's no response because they don't understand the question, which is equally fine. Because if they don't know if they did it, the answer is probably no. It is very difficult to put after-tax dollars into your 401k. It'd be like you have the option with your employer to have withholding, and at the end of the year you say, oh, I forgot to do it. Can I give you a check for $5,000 to put in my account? Most people don't do that. Most people would remember doing that. If they said, oh, I know, I clearly remember doing that, you very carefully bundle up all their information and hand it back to them and say, thank you for coming in. Good luck with your next preparer, because this is now a complex situation. We do not want after-tax dollars into a retirement plan. We cannot do the calculations with VITA. That's going to take it outside of scope. So hopefully the answer is they come back and say, nope, I made a mistake. I did not put any after-tax dollars in. We're good to go, because whatever is in the gross distribution, we're going to treat as fully taxable for federal purposes. For Roth IRAs, we're going to see this increasing in popularity. Roth IRAs are going to be a concept where you do not get a deduction for the monies going in, but all the monies coming back out are going to be tax-free, as long as you meet the certain qualifications. That the first distributions 5 years after the account was started, that the individual is either 59 and a half due to disability or an estate beneficiary or to buy first-time home purchase costs. If the tests are not met, then this could be partially taxable. So hopefully we're going to see the code that says it's a qualified Roth distribution, no issues at all. However, the Roth has some unique elements to it, and if there's a taxable component, we probably will not be able to satisfy those obligations within VITA. So just want to mention that if we have a situation, we may have to go back and see if the third-party administrator can go ahead and provide that number for us. If not, we may have to send them to an outside provider. As I mentioned before, that the partially taxable pensions and annuities are typically going to be coming through if we have a annuity, or there may be an investment in a contract. And for a couple of these, I've seen these with government employees who are retired, that they actually have a investment in their contract, meaning that they have a amount that they can recover tax-free. So one of the things we're probably going to take a look at is if you see a 1099-R and there's an amount in box 9B, that's the investment in contract. So for the very first year that they're taking that annuity or that retirement plan, we may be able to come up with a process called a simplified method. And the good news is it's pretty close to what it sounds like. It's pretty simplified. What we're going to take a look at is just getting a piece of information. The categories here that we have, the annuity has to start after July 1st, 1986. Good news is anyone who's preparing a return today, well after 1986. So we don't have to worry about that first category. And the annuity started after 1996 and all the qualifications are here. Pretty much what we're going to see if anyone has a retirement distribution with something in 9B and it's the first year, we're probably going to be able to use that simplified method. If for some reason we cannot, there's another rule we can go through called the general rule. That's going to have us do the publication 939. A little bit more complex of a process, but we can actually still prepare that within VITA, still within scope. But if you run into those issues, let's make sure we take our time and go through those because we want to have these correct. Now, the good news is the simplified method, we can do this within VITA, and it is simplified method is actually relatively simple. We do have a number of forms within your 4012. So this actually has 3 different pages of how to do the simplified method. Again, for the first year that someone's going ahead and taking the annuity or the payment, typically what we'll see is that in box 2A is going to say unknown. And there'll be an amount in box 9B to show the investment in the contract. That'll be our general sign that we can do the simplified method. Basically, the information is all right here. All we need to know is the age of the individuals. Great, we already have that because we have them in the system already. We just have to know, is this payment a joint or single annuity? And if it's joint, we'll use both ages. If it's single, we'll just use the taxpayer or spouse. And then the net investment in the annuity is typically found in box 9B. And if we go with the simplified method, we just enter, for the most part, pick and see whether it's a single or joint, and then enter the amount from 9B, and the IRS tables will automatically apply. And am I missing anything, Mike, on the simplified method? Is it as easy as described?
Yeah, most of the time we're getting elderly widows that they've already consumed all their non-taxable, so it's 100% taxable.
Okay, gotcha.
You have to recognize that also.
Yeah, so that's a good point. So the simplified method will be used for the first year you start, and then the system will go ahead and calculate. What effectively they're going to do is they're going to take that amount of investment in contract and basically pull a portion of that each month to offset the taxable piece. So it all depends on what your life expectancy is. The table will be created, but we want to just keep track. So if they keep coming back year after year, we're in great position. But as Mike mentioned, what's going to happen after a period of time, they'll probably exceed their cost recovery. And then it just becomes fully taxable at that point in time. So if they've been coming back, it's going to carry over if they've been back year after year, which is great to have returning people. So that amount should be carrying over with the amount of the simplified method. So we do have some examples here. I believe they do. Oh, I'm sorry. Yes, sir.
If it is not a previous client and they do not have a prior 1040,
Yeah.
we cannot do the simplified.
Yeah. So if they don't provide the information, we can't do the simplified method. We need to have, generally it's always good practice. We have at least the prior year return, if not 2 prior years, just to take a look. But if for some reason they have no copy of it whatsoever, their option is we can still prepare the return. We're just not going to take the simplified method. So we can't use it without knowing. Yeah, so it'd be fully taxable. Yep, that'd be our position. Okay. So what we basically would take a look at here is seeing where we're at with the simplified method. Basic scenario, here we have Bill Smith taking benefits. Oh, okay, we should have 2025 in there. Sorry about that. Under a joint survivor annuity, Bill's annuity starting date is January 1, 2025. Benefits are going to be paid over Bill's life and his wife's life. Bill has $31,000 of qualified plan basis and no distributions. So what's going to happen in this point, if we get a 1099-R, Bill's going to be receiving this and we're going to see $31,000 in box 9B. That's going to be the investment in contract. So what we see here is Bill's going to be getting a monthly benefit of $1,200 per month, and then Kathy's going to get $600 per month after Bill passes away. Good news is we really don't need to know much of that information. What we're going to get is a 1099-R showing that Bill would have received, in this case, $1,200 a month for 12 months. So that's what be reported in box 1. 2A is probably going to say unknown. They don't know how much is going to be taxable. This is our clear-cut sign to go ahead and do the simplified method. What we would do, we can use the simplified method in this manner. We're going to go ahead and go into the program under the 1099-R, select simplified method, and enter the $31,000 as the investment in contract. In this case, the IRS tables are going to be utilized. We're going to use the table 2 because it's a joint life. It would end up being a factor of 310 is where their combined lives would be. So the system's going to take that $31,000 divided by 310 and apply $100 per month as an excluded amount. So it's going to recalculate the taxable amount to basically give him a $1,200 deduction off of that taxable amount. So he'll get that for the next 31 months, 310 months as they go through that process. Okay, how are we feeling so far in the simplified method? Okay. As I just mentioned about the early withdrawal from the retirement plan, we'll have a couple of those there. Again, big thing is going to be seeing that we have a code 1 in box 7, and typically it's going to be a total distribution check mark. That's going to indicate that that account is completely wiped out. Total distribution means that that account is no longer there, which means that it has been completely liquidated. If they still have a balance, this is where we take a look at the cost recovery element, but typically early withdrawal, they're taking the full amount out. So federal automatically apply the 10% penalty unless an exception applies. And we'll talk about those 5329 penalties in just a second here. But if there's no penalty exception, we'll let TaxSlayer do its thing. It's going to automatically carry to the Pennsylvania return. For the local return, I believe we have to do a little bit of a mechanical feature to get that to work. If there is cost recovery, we are allowed to make that adjustment. Again, we have to get a number from the client to determine what their cost recovery would be. For PA, it's going to be taxed as compensation. For local tax, it's also taxed as compensation as other income. So we may need to enter that information as other income on the local return. Again, any employee contributions are going to be recovered tax-free in a cost recovery position. So your first dollars of contribution will be recovered first for both PA and for local purposes. If you exceed that, then the amount in excess is going to be taxable. Now, I did want to talk a little bit about these exceptions to the early withdrawal penalties. So there are a number of common ones, and again, you'll see this on the H6. This goes all the way down to the other taxes section. But a couple of these are going to be conversions of an IRA to a Roth IRA. Should be a code 2. That's another common one that we'll see. Full or partial rollovers. This may be where a individual had gotten a amount from their retirement account and they decided to roll it over themselves. Not recommended at all for an individual to go ahead and roll it over on their own within 60 actual days. It's not 60 bank working days. So you don't have Arbor Day. You don't have to take if the banks are closed on Arbor Day. Don't know if they are, maybe not. But you have 60 days to take the money and roll it over to a new account. But it has to be 100% of your amount distributed in order to have a full exclusion. Other than that, it would be partly taxable. But you can go ahead and do that if they've done it on their own. Generally, you're going to get a form 5498, which is going to show a contribution to accounts. So you may want to make sure a client has that. Again, we don't audit the clients, but we want to be sure they have the information in case they are. So 5498 is going to show how much they've actually contributed or rolled over to a new account. Other ones on there would be some of the code 2s, obviously the code 4. Entry in TaxSlayer, you can actually go ahead and apply some of these penalty relief functions. You can just code search for 5329 in the field. Now, there's a couple codes that we're going to take a look at. You just actually have to put in the amount that will not be subject to tax and then pick the reason why. So if we take a look at the code sections here, some of the more common ones are going to be found on H7. So we have to go ahead and use the 5329 to reduce the penalty if we see the code 1 box 7. Otherwise, it's going to be automatic. A couple of the ones I just want to point out there, code 05, it's unreimbursed medical expense paid during the year that's greater than 7.5% of AGI. This is excessive medical costs. Again, it's not going to make the distribution tax-free. It's going to eliminate the penalty. A couple of these are specific for IRAs only. That includes any health insurance distribution for unemployed individuals. It can also include IRA distributions for qualified higher education costs, like tuition fees, deduction, that type of thing. Also, you could do a first-time home purchase up to $10,000 out of the IRA. First-time home purchase does not mean the first home you've ever bought, which is what you would think that definition would be. It's very specific. It's effectively the first time you've had a home in a while is the category for that definition. So if they have it, we'll go ahead and take a look. Generally, what I would do is if you see a code 1 coming through is ask the individual, is there a reason why you had taken the money out? Is there a reason why you took the money out of your account early? And if their answer is because they told me that was the only thing I could do with the money when I left. And I'm like, first, they gave you a couple other options. The only thing you heard was I can take the cash today. But if you took it because of matter of convenience, I probably won't go too far into trying to find a penalty for them. My position would not be show them the list of penalty exceptions and say, pick one you think looks good. So I'd rather have the conversation to say, why did the distribution, why'd you take it out? If we can find a way to get it to work, that's perfect. There are a couple new ones that we have. So here at the bottom, Code 19, up to $5,000 for the birth or adoption of a child. So that could be birth or adoption, up to $5,000 from either account, IRA or a regular retirement account. Again, penalty relief only. It's still taxable. I think unfortunately people hear these and they say, oh, I can take money out of my account tax-free. That's not the case. This is only to take it out without the penalty. And Code 23, this is where we have that emergency distributions. So if the program counts, so we may see a Code 2 because the third-party administrator has agreed that it's an emergency situation. You'll find a lot of these in actually Notice 2024-55. So the references on page H7 here will actually guide you to that publication, the IRS notice, and talk a little bit more about some of these other exceptions. There's a new one also for domestic violence victims. They can take up to $10,000 or 50% of their vested balance, whichever is lower. Again, the emergency distributions, you're allowed to have one distribution per calendar year. Typically, it's going to be up to $1,000 you can take out for emergency purposes. But again, as we mentioned earlier, that can be for providing for housing, food, other necessities. And you can do that once a year for a calendar year purpose.
What was that notice number again?
Sorry, that is 2024-55.
Thank you.
Yep.
It's $1,000 per year?
For the emergency purposes. Yep. And there's some other emergency funds you're working at creating with the retirement plans as well. But typically we're seeing you have the ability, again, it's not going to take away the tax component of it, just the penalty component. Yep. Okay. Other questions on 1099-Rs? I know that was kind of our healthier section there. Okay, we'll go through a couple of these other items here. Social Security and railroad benefits. D72 will be talking about the railroad benefits. We're going to enter any Tier 1. These are actually RRB 1099s. They go in exactly the same as Social Security benefits. So if you get the blue form, that's going to be treated just like a Social Security form. And we have some references in there in your slide deck. Also in your 4012, they do a very good job. And again, if you don't know where to put it, take a look at the form and type that into the search bar, and it should take you right to the input area. The Tier 2, which are the RRB 1099-R, is the green form. That's slightly different, but there is a specific section for input there. You can use the keyword RR for railroad, kind of cleverly put in there for the IRS. We do have a couple railroad retirees, I believe. We have a fairly decent train community around here, which is great. So you may get a couple of those. Again, if it's something you haven't seen, feel free to ask if you have a question about how to get it in. So I don't want to scare anyone about taking a look at getting forms that are unusual. There's always going to be a spot for them. Just a couple things I want to mention here about some of these other areas. Some of these are actually going to be reserved for advanced certification like gain and loss and some business activity. So if you feel comfortable with that, we can go ahead and make sure you're well prepared. Capital gains and losses, this is going to be where we report any sales of property, which include stock, investment accounts, mutual funds, homes, that type of thing. So typically, those are all going to be reported on the Schedule D and the Form 8949. So there's one input section, and all of a sudden, TaxSlayer is going to generate a whole lot of other forms that go behind it. So typically, anything within scope for the VITA program will be sales of stock, sales of mutual funds, sale of principal residence. Now, what we need to find out to basically report these accurately, we need to know the sales price. That one's generally pretty easy, and it's probably the easiest one to get. Often, we also have to get the adjusted basis of the asset. So that basically is for stock, it's whatever you paid for the stock. For your principal residence, it's whatever you paid for the home. It could be a change in value upon the death of a spouse. It could be improvements that you have to your home. The good news is most of the clients we have for VITA are going to qualify for a home sale exclusion. So I believe most of the ones we've seen through here have always been home sale exclusions, and so we'll go through what that would look like. We have to know the holding period. Is it 1 year and less, which means it's short term, or is it greater than 1 year? So as I mentioned about the qualified dividends having a special tax rate, long-term capital gains are also at a special tax rate, as low as 0. So I have seen returns come through because the individuals have qualified dividends and long-term capital gain. It looks like they have taxable income and the tax shows a 0. That's entirely fine. The itemized deductions or a standard deduction will actually wipe out their other income first. We kind of hold on to those special deduction items at the end.
Question?
Yes.
Are limited public partnerships included, like a stock? I saw one of those once last year.
Yeah. Partnerships are a little tricky here with VITA because if they're getting K1s, yeah, I think on a limited basis we can handle K1s, but in general rule we don't typically handle K1s. Public limited partnerships are similar to a stock, but a little bit different. Yeah, so if you get one, you probably check with your site coordinator to see if it's still within scope. Yes.
I was just gonna say, is that a K1 through the, like Merrill Lynch, or would that be a K1? Because a partnership 1065, I don't think is in our scope.
Correct, right. So the question is whether or not partnerships and K1s are within scope. Technically, I believe that they're not in scope. If they're a basic one and there's advanced certification, there might be an opportunity to take a look at it. But generally, we recommend not to touch K1s because of the complexity with them. Hopefully, we don't have people who have very significant investment strategies and are coming into VITA for tax planning purposes. I think if you have a broker that's gotten you into alternative investments, you could probably afford a couple dollars to go out to a outside service. So hopefully we're not going to be in those situations. So typically K1s would not be within scope. Yes.
You say capital gains and losses are reported on Schedule D and Form 8949.
Yes.
Don't we get those from Form 1099 DIV?
Well, yes. So great question is, how do we report capital gains? So typically we may see a 1099B, which will come from the broker, which is going to be a schedule that'll show sales of stock and other securities. So typically, if you have a brokerage account, you'll probably get a 1099B, which will list all of your transactions. The good news is for TaxSlayer is we can actually just go off the summary information at the bottom. So if they have short-term securities sold that are covered securities, we'll just enter that as a summary detail right into the program. It's automatically going to go. The 8949 is effectively a detail schedule of all the capital gains based on the stock holding period. All those totals then flow to the Schedule D. That Schedule D then flows to the front page of the 1040. So there's a lot of reporting when it comes to our capital gain transactions. But the information we're going to get is going to come from probably a 1099B, which then is entered into TaxSlayer, which then flows to the appropriate parts. Again, the important part we need to know the sale price, the sale date, the purchase date to determine short-term or long-term, and we have to have that adjusted basis. Again, if they don't know what their adjusted basis is, we can give them a number. They don't like it. It's 0. That's the number that the IRS will give them. We can go back and ask for their broker to come up with a number. Sometimes you'll see documents that say unknown. Well, the broker may actually have one. They just don't want to put it on the front page of the document. So generally, their broker may be able to go back and handle some of that information for them.
Are you talking about carryover losses from prior
Well,
years?
so carryover losses are going to be a little bit different. So good point on carryover losses. We do want to double check a prior year return to see if there are any carryover losses. So to give you a quick update on capital losses, if you sell property and you have a capital loss, you cannot deduct the full amount of loss. You can only deduct up to $3,000 per year or offset other capital gains. So if you have excess of capital loss over capital gains, you can take $3,000 per year against other income. That continues indefinitely. So we may have people that are carrying over. If they've been in the system, that'll automatically carry over. If they're a new client, we do want to double check their prior year return, particularly Schedule D, which will show the amount of carryover. I actually have a client that has a little over $1 million of capital loss carry forward. So either we have to come up with a lot of capital gains in the next couple of years, or they have to outlive everyone to be able to use that at $3,000 per year. That's going to be a new record here to see if they can use that thing up. But hopefully we have some capital gains to offset that with. Typically, like I mentioned, we're going to see these proceeds from sales being reported on the 1099-B. And any stock sales for real estate will be on a 1099-S. Hopefully, if it's a sale of a home and it's a principal residence, that the title company knows it's a personal residence and will not issue a 1099-S. If one is issued, these are generally large dollar amounts. We should get that on the return. So if you see a 1099 coming in and the taxpayer saying, be sure that gets on the return. Again, as we take a look at the basis, it's going to be the original cost of the asset plus any commissions, fees, improvements, that type of thing. So a couple things we want to take a look at. If a spouse gives property to the other spouse, we just get the carryover basis. It stays the same. If you inherit property, the property is going to step up to the fair value at that individual's date of death. So not that we're going to talk about estate planning here, but if you have your choice of getting money while the person's alive or after they pass away, I'll take the cash today. But if you have appreciated security, I'll wait until we have your service. That's fine. We don't need it today. Prefer to have that step up in basis, so we don't have to pay tax on that at all. Gifting is going to just be carryover basis as well. So for sale of a principal residence, I do want to mention that typically we're not going to have tax on a sale of a principal residence. What we're going to take a look at here, you do not have to report it if you meet all the qualification rules unless you get a 1099-S. That would be the one main reason we'd probably report the sale of a home. You do not need to go ahead and report it otherwise. If there's no 1099-S and you meet all the qualifications, it does not need to be reported. But if you take a look at D52 in your 4012, it actually goes through the procedures in case you need to report it. But the main thing is, what are the rules? The basic rules are you have a 2 of 5 year test. If you've owned the home for the last 2 of 5 years and you've used the home for the last 2 of 5 years as your principal residence, you will meet the exclusion capabilities. They do not need to be simultaneous. The IRS has a lot of great examples of how in the world you can be living in your home and not own it, and then own it but not live in it. Don't know who came up with that question to the IRS to say, what if I rent it and live in it, and then I buy it, and then I decide I don't want to live in it, and I rent it out? Okay. You're fine. 2 of 5 years. Most people around here will be in the same home. Temporary absences aren't going to be a problem. Where we may see this are people transitioning to retirement communities. Maybe they had the expectation they'd get back to their home, but yet they're in a facility and they just never get to the point where they're able to go back in their home. So it might be vacant for a period of time, but we still have that 2 of 5 years. Pretty big window. As long as they've met the 2 of 5 year test, we get up to $250,000 per taxpayer. So a single individual has a $250,000 exclusion. Married filing jointly is $500,000. So if you have a nice elderly couple coming in and selling their home for $450,000 and they lived in there for the past 30 years, good news, there's no tax. There's no possible tax if they have a $500,000 exclusion and their sale price is less than that. In most cases, we're probably going to be okay here in Lancaster County. Again, I don't think we've seen anyone coming in here to say, I've sold one of my properties for $7 million. Can you help me out with the calculations? Again, they're probably not coming into our King Street site to go ahead and ask questions about that. Okay, how are we feeling on sale of property? Any questions? Just want to hit a couple last items here on some business income items and some other quick pieces. So business income, if we have any individuals who are self-employed, we're seeing a little bit more of people now in what we call the gig economy or looking for part-time jobs, finding ways in which they can monetize some of their free time, whether that be working and doing things like driving for Uber or doing DoorDash, whether it's doing craft work on Etsy. We're going to see that we have reporting requirements now. So currently the 1099K is going to be for credit card transactions. That threshold's still relatively low for 2025. Starting in 2026, it goes up to $20,000. So we're going to see that kind of fade away a little bit again. But we may see some additional items coming in. But we may see a little bit more of self-employed individuals as people are looking to make a little bit more money. Any self-employment income is going to be reported on the Schedule C. This one's a little bit more complex, and we don't actually have a prescribed form necessarily to say how much you have in income and how much you have in deduction. Hopefully the taxpayer has brought pretty good records. Now, the other benefit we have is there's actually what we call a qualified business income deduction, automatically calculated. So 20% of their income is not going to be subject to tax. They're actually going to get a deduction for 20% of their income. So if they made $10,000 as a self-employed individual, you'll see another deduction show up in the 1040 for $2,000. That's going to basically make their income only 80% taxable. However, they're going to be subject to self-employment tax. So we're going to see that come in. That's actually going to be automatically calculated within TaxSlayer. So there are a couple businesses that are going to be out of scope for VITA. If they have more than $10,000 of business expenses, if they have a loss in the business, if they have employees, if they have returns and allowances or inventory, if they're farmers, if they have depreciation, home office, or health insurance. If they're trying to run their own business, they probably, again, should not be coming to VITA for help on getting that taken care of. Yes, sir.
That simplified qualified business and income deduction, is that like any small business can take that if they're just an individual with
Yep.
just doing crafts or something?
That is everyone. That is pretty much everyone who's in, for our purposes here, there's a couple different categories. Professional athletes have some special rules. I don't think we have any professional athletes. If anyone knows Nick Kurtz, if he's coming back as AL Rookie of the Year, who grew up here, would be great to get that return. I'm pretty sure they're not going to have him do that here at VITA. But there are
So
some
you can just
exceptions.
use that instead of detailing your expenses, is that?
Well, no, you still want to detail your expenses. So the question is, can you replace your detailed expenses? This is an addition. So this is on top of your normal deductions. So we're going to take a look at your net income and you're going to get 20% of a additional deduction based on that. So this is on top of that.
Huh?
But every business we have, whether it's going to be people babysitting, people doing painting on the side, would be eligible for this qualified business income deduction. A couple things that we may actually get some reporting. The 1099 NEC. Now, 1099 NEC stands for non-employee compensation. This may be where an individual is working for a company, not as an employee, but as an independent contractor. So they may get a 1099 NEC, which is going to have to be reported on the return. That's basically that they're in a position, but they're not considered an employee. They might be doing something like maybe cleaning services for a company. So they're going to be issued a 1099 NEC. We're going to report that on line 1 of the NEC. And in TaxSlayer, there's actually a special section. You can enter the NEC and then tie it directly to the Schedule C. 1099K, I think we're going to see a lot more of these because these are going to be issued for people who have credit card transactions. So people who are using even Square or PayPal, if they're doing things on Etsy, if they're doing things on eBay, if they're doing DoorDash, they're going to get 1099Ks to report the amount of income that they receive. Again, the filing thresholds are relatively low for the 2025 year. So anything payment on credit cards, any bank transactions will be on a 1099K. So again, take a look at D33 and D34 for how to tie those in. You mentioned about business expenses. So the good part is a lot of business expenses are actually still within scope for VITA. That includes things like advertising, standard mileage rates for car and truck expenses. So that's where we'll see people who are doing delivery services be able to deduct their expenses. Commissions, fees, interest, insurance, hopefully not a whole lot of legal and professional services, but office expenses. So that may include if they have to do any type of products or invoicing, rent or lease of vehicles, machinery, or equipment, repairs. The biggest one we may see are things like supplies. So if you're an Uber driver, you may have cleaning supplies, maybe you have a nice little assortment of mints and other accessories for your passengers, maybe a tiny little bottle of water, which would be great. Get your 5-star rating up. Those are all deductible expenses. If you are a house painter, your materials, your paints, your brushes, all those rollers would be deductible as well. So those are all fine and within scope. Utilities, this is always kind of a unique issue when it comes to how much of my cell phone can I write off. If you have a family plan and you have 8 people on it, I wouldn't be so aggressive to write the entire plan off as a business expense. If you have a legitimate business and you use your cell phone for business, I think the presumption is we have been able to take the business phone or that line as a business expense. If the IRS audits, be sure to delete all your other apps off your phone so it looks like it's mainly business and not just playing Fruit Ninja or other games on your phone. But traditionally, we don't want to go overboard with some of these. Some of the red flags we do see with the IRS, we do want to remind clients that they have to provide the documentation. If a client's sitting there and you keep asking their expenses and they keep just throwing numbers out at you that keep getting higher or lower, depending on how your reaction is, we may want to remind them that the IRS is going to ask them for substantiation, that they need to prove their expenses. For the most part, people are not coming in here trying to defraud the VITA system. They're not trying to do that to increase their earned income credit. We haven't seen that happen here in this region, but it has been an issue in other areas, not within VITA, but people understand how the earned income credit works, another topic we'll have for our next session. If you come in with an all-cash business, if you say, I watch the neighborhood children, and I make exactly $18,078 per year, no expenses. Do you have any receipts? Nope. That's exactly what I make, which happens to be potentially exactly what you need to maximize your earned income credit. We don't have those happening here in VITA, but those are red flags, even numbers. You know, if you're driving exactly 10,000 miles a month each and every month, something sounds a little off, right? Not every month has the same amount of days in it, but we want to try and take a look at those. Areas where we have expenses, we should have expenses written down. So usually that's what the IRS is going to take a look at. Generally, again, for the cell phone, your first line is typically deductible. But again, don't try and write off your 8-year-old cell phone bill as a business expense, unless you figured out how to hire them in the business. But then you have child labor laws unless you're Amish. Yes?
Some of these, driver type jobs, and the people haven't kept track of their mileage. Is it okay to put like a reasonable amount of mileage in there, even though they don't have documentation? Say I know I went on 100, runs or something. Could you put like 5 miles a run or something like that?
Yeah.
I know they're definitely responsible for it, but
Yeah.
it seems a shame not to give them anything.
Yeah. So the question is what happens if they don't have accurate logs of their miles? We cannot give them a number. If they come back and
They
provide
want to
one.
say, well, can I use this number? I mean, we can't.
Yeah.
I mean, we can't say yes or no. It's their responsibility, but.
Yeah, they're basically going to have the responsibility to demonstrate that. Now, the good news is most driving apps should have a mileage log. If they're using the app effectively, they can log in and it should show them all their
I've seen some where they don't, and they just.
Okay. If they don't, they're
I'm
going to have
not
to.
recommending a number, but I just say, well, if you kept track, they say, well, can I use this? I mean, I don't know what to do in those situations.
Yeah, so the question is if they have a number.
But they have nothing written down.
Yeah, again, we have to keep reminding them that the record substantiation is on them.
Yeah.
So if they have a legitimate number that they're bringing to you, I think we're a little bit more lenient on that. If they're just making something up, obviously not something we want to deal with. But it's going to be their responsibility to have that documentation. Again, hopefully their app, especially for Uber drivers, they should be able to log into their account.
Uber has it.
Yeah, Uber's pretty good about that. If someone's delivering for
I
something
think it was
else.
the DoorDash. It didn't have it. Maybe they do now. But
Yeah, DoorDash should have it as well. The only one might be if you're driving Amish families around. I don't think they have one yet, unless someone wants to develop that app. If someone has some software skills, most Amish are pretty good at their cell phones right now, so you can come up with your Amish driving app. But most of these probably can download that material. Again, I highly suggest they come up with a number for us. And for the IRS purposes, it has to be contemporaneous, meaning it has to be when you had done it. I've been through audits, and the IRS generally wants you to know your mileage as you had driven it, not 3 years going back and saying, well, I think I went here on that date. They want mileage logs, and we can just remind them of those documentation procedures. But I have a list up here of what typically we see from Uber drivers or DoorDash drivers. Again, generally have them go ahead and pull down their reports from their app. It should show what they have in terms of revenue. Should also show if they're paying commissions and fees. So the 1099K might be the gross amount, but they get to deduct any of the credit card fees, any of the commissions they need to pay. Obviously, any cleaning supplies, those types of things would all be included in their expense categories. Okay, questions on Schedule Cs? Again, that's technically an advanced certification. Yes?
Last year, I remember several that came in that had like a small business would issue or treat them as self-employed even though they were employees. So instead of giving them a W-2, it's almost like that was another expense for them or too difficult for them, and they would just treat them as self-employed even though they were not.
Oh, okay. So the question is, so people had worked for a company, but they were being treated as independent contractors rather
They
than...
get a W-2, they would get,
Well, yeah, that sounds like a Department of Labor issue of how they're being classified. But yes, if they're getting a 1099 instead of a W-2, we still need to report that. They're probably being misclassified. And we sometimes have those situations where you may have maybe someone who works in construction who the contractor wants to hire them as a subcontractor so they don't need to pay for health insurance or other benefits or unemployment. If that's the case, then that individual needs to keep track of all their expenses, all their tools and materials, that type of thing. If they get a 1099, we're going to have to show it on the return. If we don't, then they're going to be part of the IRS summer letter program. That's going to be some correspondence that we don't like to be part of, where they get a not so friendly letter from the IRS that suggests they owe several $1,000s more in tax. A little bit more strongly worded. But if we do get the form, we do need to go ahead and report it. Okay, taking a look, just two last things I want to mention here. Gambling, winnings, and other income. So we are seeing people who are participating in the proliferation of online casinos. We have a number of casinos in the general area, and we also have the convenience of being able to play on your phone. I see none of you are playing right now, which is great because you're paying full attention, but I have had clients that have run into situations where their handheld devices become addictive. Gambling winnings are taxable. They're going to be taxable for federal and for state purposes. Now, they should be getting a W-2G. So every time someone wins a jackpot, they should be getting a W-2G. What's going to happen with these casinos is every time they win, they're going to get another W-2G. In TaxSlayer, we've been entering each one as we get them because they're separate forms. If they don't have a W-2G, we can have them pull up their app. If they say they don't know how to get it, they absolutely know how to get into their app. They don't like to see it, but it's going to give them all the detail of how much money they put in and how much money they've won. So whether this is coming from online casinos, online gaming, online sports betting, any of the winnings would be considered gambling winnings and subject to taxation. So what will happen with gambling winnings if you're basically cashing out? That's going to go ahead and trigger the W-2G. That's going to be reported as federal income. Now, you may have the ability to offset your gambling losses, but you can only do that to the extent of winnings. And you can only do that if you're going to itemize deductions. So we'll talk about itemized deductions next time. The good news I had from my client who became addicted to online gaming is she won a lot of money. She was up over $100,000 of winnings in 1 year, which sounds great. As a single mother, that would have been awesome to go ahead and get your own place. Except she also blew that $100,000 back again in the casinos. So the good news for us is we had to pick up the $100,000 of income, but we also got to take a $100,000 deduction on her Schedule A, so it offset. PA will also allow you to offset your gambling winnings and gambling losses. Her boyfriend at the time also got into gambling, won only about $8,000 over the year, But because you couldn't itemize deductions, we weren't able to offset the losses. So we had to pick up $8,000 of income with no offsetting deduction. So if you have people who are gambling, I'm not going to suggest tell them to go out and if they won big, lose big. Just go ahead and keep playing the lottery. Don't tell them to go down to the local convenience store and start diving through the Powerball tickets that are not winners, which do count, by the way, to prove your losses. But please don't get caught on film going through the trash at the convenience stores looking for receipts. But you can offset your losses.
It seemed like last year, I remember that you had to have a winning over $300 per betting event before it got recorded, something like that.
Yeah, typically the
But now you're
W2Gs.
saying it's the cumulative over the year?
Well, so two different situations. Jackpot winnings will generally trigger a W2G. So if you hit a jackpot on a slot machine or a table game, they're generally going to issue a W2G at that time. However, they can take a look at your cumulative amount of winnings, and if you cash out, they can issue a W2 at that point as well. So if you put $500 in your account and you play a couple games and you cash out for $1,200 later, you've made $700. So that technically would be reported as gambling winnings.
Now, if they don't issue a W2G, you don't necessarily have to record.
Yeah. No, it's a great question. I love the question. If the casino does not give you a form saying how much you won, should you report how much?
Well, yeah,
Legally, yes. Yes, you should have the individuals report how much they've won.
I'm talking about these sports betting.
Yeah, sports betting.
FanDuel or something. Say they don't give you a W.
They typically do not. So just something we want to, if you want to ask the question and open up that can of worms. I don't know if we want to do, maybe we have a poster at the site to say, please enter this line if you want to report gambling winnings. So FanDuel and others may not give you a W2G. Technically, any income would be reportable to the IRS. So make sure that we show the recording on here. Any income that they win is certainly to be reported to the IRS in the Commonwealth of Pennsylvania. Yeah, John.
I heard that if you win a lot of money playing craps or playing the game, that's not reported. That you're not issued a.
Correct. Right. So the table games may not issue W2Gs, much like the slot machines do. So it all depends on the type of casino that they have. But generally, table games don't have the W2G reporting. Doesn't exclude you from reporting it as income. It just is not necessarily reported on W2G.
But the casino doesn't report anything to the IRS.
Correct. Right. So even though they might not report it to the IRS, it doesn't exclude the winner from reporting it. So again, we may see that here in the area, just as we see a couple more table games, more people. If you haven't watched TV at all, you probably have been excluded from watching every betting app trying to go ahead and get some money from you here. With the little caveat is, if you have a gambling problem, please call this number. Right. But they highly encourage sports betting. So we may see a little bit more of that. Some other income we may see on here might be jury duty pay. Again, any gambling winnings not reported in the W2G, I just want to make sure that we are aware that they should be reported. If they're going to tell us, that'll be on the return. If the client tells us something, we can't unhear it. So be sure that they know. If you're asking, do you have any other income? Oh, yeah, I've made $7,000 in FanDuel last month. Okay, well, guess what we have to do now? So now we're going to have to figure out how to report that. You may have some prizes and awards from a 1099 miscellaneous. That's about the only one we'll probably see now in the 1099 miscellaneous is any award. If they won like a radio call-in show or if they gotten a prize, that can be reported there. Lastly, I just want to touch on one remaining issue, which is another one that's going to pop up here, is debt cancellation. Debt cancellation, again, outside of the ads for your online casinos, is refinance your debt. How do I get out of debt? So debt consolidation, debt forgiveness programs are actually going to lead to taxable income. Because when we take a look at the tax code, taxable income is going to be any type of cash you get or any other type of economic benefit. If you used a credit card and you ran up $10,000 of charges to buy food, clothing, and travel, and all of a sudden the credit card company says, just pay us $5,000, not $10,000, you have $5,000 of income. They're going to report that income to you on a 1099-C. So 1099 is going to be a cancellation of debt. That is going to be considered taxable income. And if they have more than $600 of debt, that'll be reported to the recipient. Typically within VITA, very easy to handle this as long as it's personal debt. meaning not business debt. As long as it's shown on the 1099-C, we're in good shape. There's no interest, which typically does not occur. Not business related, not related to bankruptcy, and they're not going to claim insolvency exception. Now, the insolvency exemption means that you actually have more liabilities than what you have in assets. And insolvency means that if you have your debt canceled, you're still not back to break even. Homeless people are still better financially off than you are because you owe more debts than you have assets. That is going to be outside the scope of VITA. However, Mid-Penn Legal Services is a great resource to send people for bankruptcy or if they need insolvency help. So they actually work with this with their group. So a kind of peer organization of ours, a great referral source if someone needs help with their debt cancellation or bankruptcy. So as long as that is the case, it's personal credit card debt. Someone may say, hey, look, I finally got out of this. My Visa bill was just dropped in half. I have a 1099-C. Typically, we'll just pick that up as other income. It's going to show up on the Schedule 1, line 8C. Again, a couple of publications if you want to take a look a little bit more. If there's any more significant debt like student loan interest or foreclosure debt, please go talk to one of your site coordinators. We'll bounce up the chain. We don't see those very often, but we can handle those. So if you have those issues, please let us know. We can try and work through those either within VITA or maybe a referral out to Mid-Penn Legal Services. Okay, so healthy session today. Yes, sir.
Could you touch on waiver income?
Oh, Medicare waiver income?
Yes.
Yes. So that one I actually have some slides in my next session for the Medicare waiver, but very important because it actually has some exclusion from income. So I always debate whether I put in income or deduction. So I definitely have it in the next section to talk about the Medicare waiver payments. Yes. So thank you very much for coming out today. Hope you have a wonderful Thanksgiving holiday, and we'll see you the following Thursday. If you have any questions, feel free to let me know.